A business credit card is a separation instrument first, a rewards instrument second, and a debt instrument never. The reason to open one isn't the points, and it isn't the float on the monthly statement. It's that paid in full every month from business checking, the card carries no debt, keeps every business charge off your personal card, builds a separate business credit profile, and earns you something on legitimate business spending. The framing matters because coaches who open it as a debt instrument end up using it as one. And that's a different conversation in a different module about consumer credit hygiene. Pay it in full monthly from business checking and the structure works. No debt carried, no interest paid, personal card stays clean of business charges. The card statement feeds your bookkeeping software via a native integration, and your bookkeeper sees one consolidated month of expenses every cycle. Carry a balance and the structure collapses, you're paying interest from operating cash, you're confusing separation by treating the card as flexible personal borrowing, and the rewards you earned on the spending are nullified by the interest charges 3 times over. Autopay in full from business checking, set up the day the card arrives, is what holds the discipline in place. 3 reasons to open the card, and they pay back on 3 different time frames. Separation pays back every month at bookkeeping close. Business expenses on the business card, personal on the personal. Your bookkeeper closes the month in half the time. Business credit building pays back in years 2 and 3 when you may want a line of credit, an equipment lease, or an SBA loan. Dun & Bradstreet, Experian Business, and Equifax Business are separate from your personal credit, and on-time use of the business card is what populates that profile. Rewards pay back continuously and depend entirely on whether your highest spend category lines up with the card's reward structure. The personal guarantee reality is the thing most coaches don't expect when they apply for the first business card. Almost every small business credit card requires you to personally guarantee the debt, meaning your personal credit is on the hook if the business defaults. This is standard for any business under a few years old without an established credit profile of its own, and it's the lender's risk control, not a signal that the card should be used personally. The card is still a business instrument for accounting purposes. The expenses are deductible business expenses, the statements feed the business books, the rewards are business rewards. The guarantee just means the issuer has recourse to you if the business stops paying. Category alignment is where the rewards calculation gets interesting, because the right card for a coach depends on where your spending actually concentrates. Common coach spending categories are software subscriptions, office supplies, travel for conferences and client visits, and meals at the 50% deductibility level. If your spending is software heavy, Zoom, calendar tools, automation platforms, AI subscriptions, course platforms, a card that pays elevated cash back on software earns you back more than a travel miles card whose miles you'll never use. If you're constantly on planes to conferences and client sites, the reverse. Match your top spending category to the card's reward structure rather than chasing the most marketed card. Application timing matters because of the order of operations with the checking account and because of how the credit pool works. Open the business checking account first. The card application asks you to designate the funding account for the monthly auto pay, and you want that to be the business checking account from day one, not your personal account that you'll have to change later. Most card applications run a soft credit pool initially to pre-qualify, then a hard pull at approval. Personal credit above 700 typically approves without friction for the cards a coach would consider. Below that, the application is worth pausing while you address the personal credit first. Module 19 has the vendor-by-vendor comparison, which specific issuers offer which reward structures, which annual fee tiers pay off at which spending levels, which integrations actually work versus which ones are marketing copy. That comparison lives there because the specific products change every year. Fee schedules shift, reward categories rotate, integrations come and go. Module 6 teaches the criteria you'll evaluate against. Module 19 is where you compare specific products at the time you're shopping. Trying to do 19's job inside 6 ages the content badly the first time a major issuer changes a reward structure. Open the business card decision sheet, pick your 2 highest consideration cards from whatever's current when you take this course, and score both on the 5 criteria. Rewards fit for your actual spending categories. Personal guarantee terms. Business Bureau credit reporting. Not every card reports to all 3 bureaus, and the cards that don't won't build the business credit profile you opened the card for. Accounting software integration. Native feed beats CSV import every month. Annual fee versus effective cashback. A $95 annual fee on a 2% card pays for itself at $47.50 of qualifying spend per year. Apply for the higher score this week. Set up the auto pay in full the day it arrives. Checking, reserve, card. The structure is almost complete. The next video covers the documented flow that moves money from the business to you. Owner draw for sole prop and single member LLC. Reasonable salary plus owner distribution for S-corp. The mechanics are different for each entity type, and the bookkeeping entry has to be precise, because that entry is what keeps the personal side and the business side honest about which money is whose.